I've been warning hell is coming, and this proves everything. Now let's turn to Bloomberg because I want to show you that the U.S. economy has now hit a tipping point, and what comes next can only be described as grim. As a weak U.S. payroll gain of 22,000 cements the case for a Fed rate cut, and you might recall yesterday I said don't focus on the headline number because we talked about what it would take to get the Fed to a 50 basis point cut. Now the problem with the non-farm payroll report is it's highly inaccurate, and we have no clue what the accuracy of this report is. So it largely has to be discounted on the headline, but it's the details of the report that's what shows us we're at a tipping point. And as I've been suggesting, what comes over the next 3 months for the U.S. economy isn't going to be pretty. And while non-farm payrolls increased 22,000 in August, revisions showed employment shrank in June. That's right, it contracted. We lost jobs, and that was the first payroll decline since 2020. And it pushed the jobless rate up to 4.3%. And again, the trend on the unemployment rate is slowly rising. It's not moving quickly, but one of the problems is if we don't see the economy turn around and very, very quickly, what happens over the next couple of months is going to send the unemployment rate skyrocketing. This is a dangerous sign because it's going to impact not just millions of American households, it's going to affect workers all over the world. And with that, traders solidified bets that the Federal Reserve will cut interest rates at September 16th through 17th meeting, with Chair Jerome Powell signaling a speech last month during the central bank's annual Jackson Hole Symposium. The S&P 500 opened higher, only to pull back, and treasuries rallied. And again, this could be the beginning of a big rally in bonds. We'll see how the market reacts over the next several days, and in particular to the QCW revisions that are coming next Tuesday. We're going to likely see several 100,000, maybe 500,000 or more jobs removed from the payroll report. And what this is indicating is that the U.S. economy is far weaker than the data is suggesting. And the problem is, when we look at the payroll report right now, it says from a number standpoint, we've reached an equilibrium here. And this is exactly what I believe the Fed's going to suggest. They're going to say, well, we brought everything into balance. Now, the problem is, as we talked about yesterday, we really need about 150,000 jobs created a month to support the economy. At 22,000, we're technically in a contraction. But what we're facing now is a tipping point, one that's going to get the Fed to cut. But I don't think they're going to cut nearly as much as everyone's hoping. Let's turn to the 2-year Treasury yield, which dropped, well, a lot today. But the problem is the Fed plays chase on this, and while the 2-year yield is down to below 3.5%, which would on the number say the Fed should cut 50 basis points. What I want you to see on this chart here, the funds rate against 2-year yields in red, is the Fed follows yields, and usually with a lag. So what the key point here is, what we're likely to see is the Fed cut a quarter point down to around 4%. They're going to leave some margin here on the 2-year, and what they're going to set up, just as we've heard from some of the Fed speakers, that every meeting going forward is live, meaning a Fed rate cut could be on the cards. Now the question is, why doesn't the Fed want to cut 50 basis points? Because they don't want to cause panic. And that's the real issue here. You've heard the Fed talk about how the funds rate has been in restrictive territory. They've done that deliberately because they don't want to spook the markets. Because at this point, if the Fed cut 50 and they continue to cut, what it suggests is we're headed right into a recession. And again, the Fed doesn't want that. They want the stock market to go higher here because right now, higher income Americans are powering the economy. They need that to trickle down. And this is exactly what we hear from Fed whisperer Nick Timmerus of Wall Street Journal. He said weak hiring this summer will make it easier for Fed policymakers to agree on a 25 basis point cut. Now, what we do know is there's usually one person in the media that the Fed turns to and kind of leaks what they're planning. We know Nick is one of those guys, and if he says a quarter basis point cut is all we're likely to get, well, that means it's probably the best that's going to happen. Because again, this is all about panic. And again, you think about the labor market here, there's been so much uncertainty due to the trade war that you could put this from a business perspective. Why would you hire until things turn around? So the softness over the summer, highly validated in the data. But again, think about what's coming forward. You have the holiday season. There's likely to be some hiring coming with that. And we could see the non-farm payroll report rise in the couple of months. But the issue here is it's all about the trajectory. And right now, what we're hearing from businesses, what we're seeing in the data is hours are continuing to get cut, manufacturing jobs are being lost, and there's a lot of uncertainty that if spending doesn't increase and in a major way, we're going to see mass layoffs over the next 3 months. But just because the labor market could unwind doesn't mean your trading account has to go with it. Let's take a look at this incredible trade we put on GDXJ. This was back on September 2nd on the open. We told all of our subscribers to buy this because it came from our new Metre strategy. That trade now up 0.98% and shooting higher today. And again, you can get in on this as well. All you have to do is grab those links in the description below and use a coupon code for your free 30-day trial, because right now the Metre strategy is included in all of our programs, and I'm working on an optimization program. I've almost got done. It's really close, and what we're going to have is fully AI optimized trading signals all across the board, including the Metre strategy, and you want to get in on this before the price goes up. Again, grab those links in the description below. Stay tuned to the end of the show for more information. Because when accounting for revisions in this report, employment growth in the last 3 months has averaged just a mere 29,000, and payrolls have come in under 100,000 for 4 straight months, extending the weakest stretch of job growth since the pandemic. So if you think about this, would rate cuts fix this problem? Not likely. Again, this is all due to a lot of uncertainty over the trade war. Businesses just don't know how to react. Now, we did see consumers come out and front run and buy a lot of things, but it didn't turn into hiring because nobody knew, would that persist? Would consumers continue to buy? And so far, they've continued largely, but based on the latest sentiment data, based on what we're hearing from PricewaterhouseCoopers about holiday spending, there's about to be a big decline. And that is the risk we're facing here, is that the U.S. economy could drop right off a cliff. And if we don't see spending increase, if we don't see hiring turn around, the problem is this lack of confidence in the economy, particularly at the employer level, as they start to suggest layoffs are coming. People are going to cut back their spending, and what happens is next thing you know, the belief of a recession turns into an all-out recession. But there was some good news in the payroll report. Let's take a deeper look. The increase in unemployment partially reflected re-entrance into the job market, but the number of people who have permanently lost their job rose to the highest in nearly 4 years. And this is good news because people have lost their job while they stay on the sidelines if they don't think there's work out there. But the moment they believe there's opportunity, well, they get off the sofa. So again, this is a good sign, and this is the reason the unemployment rate went up, because the participation rate, the share of population that is working or, here's a key part, looking for work, rose to 62.3%. And the rate for those between ages 25 and 54, known as prime age workers, increased to the nearly highest in the year. So what we're seeing here is, again, people are becoming more optimistic about the labor market, and you start to make a case of why the Fed doesn't have to go 50 basis points here is because there's signs that things may be turning around. But again, even though people are becoming more optimistic, unless it translates into spending and a big decline in this inventory overhang, it's not going to stop the trend. And the household survey said, well, things weren't quite as bad. In fact, it said the number of employed workers rose by 288,000 to just over 163 million. That's the biggest increase since April. And central bankers who pay close attention to how labor supply and demand dynamics are impacting wage gains, well, here's some more good news. The inflation risk poised to the upside as a report showed average hourly earnings rose 3.7% from a year ago. So workers continue to see pay gains at some of the highest levels in history, and that's a good sign. But you may recall there was one thing I was warning about. The one thing I said, look, this matters more than any other part of the report, because people who have a job, well, they tend to get pay raises regardless of the economic cycle. The participation rate is a good leading indicator. If people think there's work, they're going to go out and look for it. But is there more work? Well, it shows up in one spot. And this is where we want to find out, can workers afford higher prices? And well, the answer is no. Because when we take a look at average weekly hours of production and non-supervised for employees, we do see it ticked up a little bit, but it's been stuck in this range going all the way back to late 2023, meaning paychecks, while they're gone up a little bit, relative to inflation, they're just not keeping pace because workers aren't getting the hours they need. And so this puts a little bit of perspective on the participation rate. Workers are going out and saying, look, there may be jobs out there, but if there were jobs, the first place you see it is a pickup in hours. reports. So again, the risks now are high. You can see why the U.S. economy is at a tipping point, because if consumers come out here and spend, well, they can change the trajectory. But if they pull back and back off, watch out. You're going to see this thing slide right to the downside. And Howard Lutnick said, I think they'll get better. When he was asked if people should believe the BLS number will be accurate, he said that just about an hour before the report came out. And well, Howard, I know you believe that, but I don't really buy into this number at all. But I think the underlying parts of the report are spot on. What it just tells us is everything we've been talking about is there was just so much uncertainty in the economy that even all this front running of the tariffs didn't lead to hiring. Now the question is, what will the holiday season bring? If consumers are right and say they're going to cut back on their spending, well, it means the tipping point is going to go to the downside. But if they come out and spend, it could change the trajectory in the short term. And you can't replace somebody 2 weeks ago and expect a fundamental change, but what you get is an agency that's going to do its best to put out the correct numbers. Well, if you believe any of these numbers are correct, and I for one don't, well, then you could put it on the headline. But the reality here is the U.S. economy stagnated over the summer. On Tuesday, we're going to find out how big the revision was over the last year, and then going forward, it's all about consumers. And right now, based on what I'm seeing, I'm not all that optimistic. And we can say all around the world, it's not just a U.S. problem, but the labor market is unwinding everywhere as putrid Canada jobs report heaps pressure on Carney and the Bank of Canada. So again, we talk about this inflection point here in the United States. You can see in other parts of the world, such as Canada, it's already tipping over to the wrong side. Now, I've done a number of shows saying, look, Canada's falling, Canada's collapsing, and people jumped in the comments and said, Steve, it is not. Canada's booming, we're doing great. But the evidence is very clear. Your labor market is coming unwound. And what we're seeing now is a payback period from the trade war start to show up. Then we're going to get one from the pandemic. And these are going to be massive air pockets in the economy, because if demand doesn't pick up around the world, you're going to see a whole lot of this right here at home. Employment fell by 65,500 positions in August, while the jobless rate reached a shocking 7.1%. The number of projected job losses surpassed even the most pessimistic projections, because Canada's economy is getting hit hard by the trade war and a decline in demand. In August, job losses were the largest in Ontario, the heartland of the country's automotive and steel sectors. In the Toronto region, the unemployment rate is almost 9%, if you can imagine that. If you want to talk about a crisis, there's absolutely one in Canada's labor market. And again, the notion that the U.S. economy is going to hold up here, well, it's going to come all down to U.S. consumers. But one of the problems we're facing that I really want you to understand is all of this inventory buildup, well, it's causing problems at the manufacturing level. There just isn't the demand there, which is why they're starting to lay off. And then we heard from the services sector. What did they say? Look, we're seeing demand drop off. We're seeing backlogs get worked through. So we're starting to cut hours. And remember, this payroll report looks backwards, not looks forward. And that's the issue here, is these ISM reports are telling us that that tipping point, well, we're following the direction that Canada's headed in. And the labor market is shedding jobs as U.S. tariffs and tariff uncertainty kill hiring demand. But look at this. You can see there's some evidence that there just isn't demand. Total hours worked rose a mere 0.1% in August, and we're up 0.9% compared to a year ago. And yearly wage growth for permanent employees accelerated to 3.6% from 3.5%. So again, people tend to get raises during recessions or slowdowns or whatever this issue is in the economy. Workers still benefit from that if they have a job. But if you look at Canada's situation, hours worked aren't going up. So what are employers doing? They're doing the only thing they can do. They're moving into survival mode, which means they're cutting jobs. But again, this isn't just a U.S. issue or a Canadian issue. It also is a U.K. issue. It's turned there as worse than thought. U.K. retail sales deepen as data accuracy woes. So we have this growing theme of inaccurate data leads to bad policy. And bad policy, well, gets you all the wrong things. And that's the problem here, because in the U.K. they thought that things were turning around. As it turns out, they weren't. The Office for National Statistics said on Friday that the volume of sales rose 1.1% in the first 6 months of the year, less than the 1.7% increase previously estimated, and that was about a $2.7 billion drop in sales, all due to a mistake. And what this means, of course, is what we've been saying about the labor market is true, because in the UK they said, look, things aren't that good, but look, the consumer's coming back. Except the consumer didn't come back. It was a seasonal adjustment error. As UK firms cut jobs now at the fastest pace since 2021, according to a Bank of England survey. And businesses reduced employment by 0.5% in the 3 months through August, the biggest drop since 2021. And firms expect just to add 0.2% of their headcount over the coming year, a slower pace than previously predicted. So what we're finding out here is all that demand from the pandemic and from front-running the tariffs, well, what we're doing is we're coming back into equilibrium. We're seeing in the U.S. labor market, there is a sign it is at equilibrium, but the problem is the trend continues to drop. So every time we see it come down, we hit a plateau and everyone says, hey, that's the bottom. And then we drop again. Everyone says, hey, that's the bottom. Now, and just as I said, what happened? That bottom that everyone said was the bottom, well, it was just another plateau, and we're starting to begin the next leg down. And this is something we're seeing all across the global economy. And almost half the firms said they were cutting staff in response to a rise in national insurance contributions, and that was the second most out of response after lower profit margins. Now, I want you to think of this. What is going to happen due to all of these tariffs with American companies? Because they're absorbing it, they're paying it. These are profit margins are going to go down, and that's one of the reasons they're going to have to start laying off. And you can see in this chart of corporate profits after tax against the unemployment rate in red. As the unemployment rate goes up, one of the reasons is because corporate profits enter a contraction and business owners start to defend their bottom line. And we can see that going into the dot-com bubble, the financial crisis, and we know due to the trade war that we're likely to see corporate profits decelerate, perhaps even contract, and that means employees are going to hit the unemployment line and in a major way. But something that made me laugh this morning was this headline: as ECB rate cuts are over and inflation will hold at 2% according to a new poll. Well, I'll take the under on that any day of the week because I think the ECB is going to be cutting in a major way, particularly when you look to the north at the UK. They said companies are laying people off. You look at Canada, and what did the Bank of Canada do? Well, they've done nothing over the last couple of months, but you can better believe they're going to cut. And how we come back to the Fed? Well, they don't want to go 50, so they're probably going to go 25, and then 6 weeks later, you're going to watch them do another 25, and then over the next couple of months, if things continue to unwind, watch the Fed get aggressive to the downside, because based on everything we're seeing right now, the U.S. economy is at a tipping point, and when you look around the world, well, where everyone else is headed, we're following, and that's not a good sign. But something that everyone else should be following, that's our Metre strategy. Let's talk about that trade on GDXJ because it's going gangbusters, and soon this is going to be fully AI optimized. I'm working on the code for this right now, but what is the Metre strategy? It's an advanced trading system that combines all 9 professional trading strategies into a single intelligent signal generator. It provides 31 times more frequent buy signals than individual strategies while maintaining high quality through multi-strategy consensus. Now, how does it do it? It pulls in the Bravo 9, Turtle Train, 200-day cross, Golden Cross, Trend Pullback, RSI divergence, 520 EMA cross, channel trains, and Fibonacci retracement, all which are individually being optimized by AI right now. And what this is designed for is to be optimized for swing trading. Gives you a target hold period of 2 to 15 days, generates over 155 signals per year, and has a success rate of 55% with fast profit taking, again, fully optimized for swing trading. But again, this is only going to be available to our existing subscribers for a limited time. If you want to get in on this, you've got to sign up now. Now, whether you want to trade machine, positioning, or momentum, either way, sign up for either report. You get it at no additional charge. Right now, you get the daily report. You get all the tradable signals, including the Metre strategy trades. You get my opinion on the best trades. I give you risk control levels, a full tracking of all open trades in return, a weekly update, and again, the best part of all is a free 30-day trial. It means you don't have to put a dime out to try any of our reports or to trade them. Grab those links in the description below. Use the coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.